Stop what you're doing. Seriously, if you own any stock in the telecom or enterprise software sectors, you need to hear this. Last week, I ran the numbers on a massive new acquisition through 5 distinct valuation models, plus Warren Buffett's and Peter Lynch's personal investment checklists. And what I found in the Q1 financials, it completely shocked me. Look, we all know the absolute worst fear of retail investors, right? Buying at the very top of an M&A rumor or getting totally lost in the jargon only to be left holding the bag. But I promise you a clear, actionable framework here. By the end of this explainer, you are going to know exactly whether this deal is a Buffett-style value buy or a classic value trap. Japanese tech giant NEC just announced a massive takeover of US-based CSG systems. So why would they pay such an astronomical premium for a billing company? Look at the sheer scale of this move. $2.9 billion. That is the implied enterprise value of this buyout, with NEC paying $80.70 per share in pure cash. For context, that's a staggering 17.38% premium over CSG's share price, literally the day before the announcement. Let that sink in. But NEC isn't just burning billions for fun here. It's like snapping the final, perfectly shaped puzzle piece into a global monopoly. They are buying a deeply entrenched, highly profitable telecom engine. All right, here is the roadmap for our explainer today. We're going to cover the deal deconstruction, the strategic synergies, CSG's financial momentum, their market position, and finally, security and future readiness. Let's get right into it.
Section 1, the deal and synergies, unpacking the strategic rationale.
The mechanics here involve a reverse triangular merger. Basically, NEC creates a subsidiary that merges into CSG, which is crucial because it keeps CSG's existing contracts perfectly intact. And when you map this out, it shows exactly why NEC wanted this deal so badly. Netcracker, which is an NEC subsidiary, is already a telecom software powerhouse with a massive stronghold across Europe, the Middle East, and Asia. CSG, meanwhile, holds an absolute fortress of a customer base in the Americas for billing and payments. They fit together seamlessly. There is almost zero geographical overlap, but massive capability overlap, instantly giving NEC a dominant foothold in North America. Now, this acquisition isn't merely about buying a new map of customers. It's about immediate, tangible value. This deal is projected to drive a 7.7% increase in NEC's non-GAAP earnings per share right out of the gate. And here is the real kicker, guys. That projection is calculated without even factoring in the strategic synergies we just talked about. Any cross-selling of Netcracker products to CSG clients or vice versa is pure upside. It is a highly accretive deal for NEC from day one. Moving right along to Section 2, financial momentum, validating CSG's upward trajectory. You don't just drop $2.9 billion, which is a 10.3x multiple on projected 2026 adjusted EBITDA, unless a company's standalone momentum is staggering. Look at the sheer velocity of CSG's recent growth here. Comparing Q1 2025 to Q1 2026, revenue climbed from $299.5 million to $313.7 million. But the bottom line is the real story. Net income skyrocketed from $16.1 million to $23.9 million. That is a massive 48.2% year-over-year jump. Diluted EPS followed suit, jumping over 45%. This is a company firing on absolutely all cylinders just as the acquisition talks were finalizing. But is not just a one-quarter flash in the pan. CSG is the textbook definition of a fundamentally sound business. They've increased their dividend payouts for 13 consecutive years, including a 6% bump up to 34 cents a share approved in January 2026. And while they were returning all this cash to shareholders, they were simultaneously paying down debt. They reduced total debt from $590 million in 2023 to $560 million by the end of 2025. And what's driving all this cash? A highly successful operational shift toward high-margin SaaS, software as a service, and related solutions. They are growing the top line, shrinking the debt, and paying the owners. It's beautiful. Section 3, Market Position and Software. Let's look at the intangible edge. In enterprise software, the balance sheet tells you what a company has done, but third-party validation tells you what it will do in the future. Being named a major player in the IDC MarketScape isn't just some vanity award. It's hard proof of enterprise-grade capability. The IDC report specifically highlighted CSG's Ascendant platform for its ability to handle massive, large-scale transactional volumes and real-time rating and charging. Look, in an era where telecom companies are absolutely desperate to monetize 5G through complex, usage-based subscriptions, CSG actually has the heavy-duty infrastructure to make that billing accurate and happen in real time. Section 4, Security and Future Readiness. Building a resilient digital foundation. Cybersecurity and corporate governance are so often the silent deal killers in tech M&A. I mean, how many deals have we seen fall apart during due diligence because of massive data liabilities? But for CSG, their framework is built right on a zero-trust architecture. They maintain 24/7 monitoring, robust endpoint detection, and enterprise-grade firewalls. Plus, they are constantly upgrading their certifications, successfully transitioning to the rigorous ISO 27001:2022 standard and PCI DSS version 4.0.1. When your software processes billions of dollars in telecom payments, your security has to be absolutely bulletproof. By buying CSG, NEC isn't inheriting a security debt, they are acquiring a digital fortress.
And that future-proofing extends way beyond just hackers. CSG has established a highly mature environmental, social, and governance framework. As AI sweeps through the software industry like wildfire, CSG already has a formal AI use policy ensuring ethical and compliant implementation. They're holding themselves accountable to global ESG reporting frameworks like SASB and rolling out new CDP climate risk scoring. This matters immensely to a global, publicly traded Japanese parent company like NEC. CSG is giving them an enterprise-ready, ethically compliant operational framework literally from the moment the ink dries on the contract. So, taking all of this in, the perfect geographic synergy, the immediate earnings boost, the flawless balance sheet, and the bulletproof digital infrastructure, we are left with one massive question to ponder. What does this $2.9 billion consolidation mean for the broader telecom software market? NEC has just united two regional giants, CSG and Netcracker, into an absolute global juggernaut, permanently raising the stakes for every other software vendor in the space. The puzzle pieces have officially been snapped together. Keep a very close eye on this sector because the ripple effects of this mega deal, they are just beginning.